Home prices in your city may be slipping, but the cost of owning that home has never been higher. Taxes are climbing, insurance is tightening, repair bills are landing harder than expected. And for many homeowners, the monthly payment keeps rising, even as the value underneath it starts to bend. This is the part of the housing slowdown most people miss. When prices stop climbing, leverage shifts quietly. Buyers hesitate. Sellers wait. Deals fall apart. And the people who bought near the top discover that cheaper listings around them do not mean cheaper lives. So here's the question you need to ask yourself. Which U.S. cities are making people poorer precisely at the moment homes look more affordable? For most of the past decade, the U.S. housing market trained buyers to believe one thing: waiting was risky and buying almost anywhere was safe. Cheap credit smoothed over bad math. Rising prices masked weak fundamentals, and as long as values climbed, nearly every mistake looked temporary. That environment is gone. Interest rates did not simply rise, they reset expectations. Monthly payments now matter more than list prices. Buyers are no longer competing for homes, they are competing to avoid regret. Financing falls apart more often. Inspections kill deals that would have sailed through 2 years ago. Sellers are discovering that the price they need is no longer the price the market will accept. At the same time, the cost of ownership has moved in the opposite direction. Property taxes are recalibrating upward after years of inflated assessments. Insurance carriers are tightening underwriting, especially on older housing stock common across the Northeast and Midwest. Utilities, maintenance, and labor costs have risen faster than wages. In many cities, owning a home now means absorbing thousands of dollars per year in expenses that were invisible during the boom. This is why the current slowdown behaves differently from past cycles. Prices are bending, not collapsing overnight. Inventory builds quietly, listings sit longer, price cuts come in stages, losses accumulate slowly for anyone who bought near the peak and cannot refinance, cannot rent at projected rates, or cannot sell without taking a hit. Another shift is just as important. Migration patterns have softened. The remote work surge that once sent buyers pouring into secondary cities has slowed. Some workers are being pulled back toward offices. Others are staying put rather than relocating again at today's borrowing costs. That reversal removes a key demand pillar from many markets that relied on inflows rather than organic wage growth. This is where leverage changes hands. Buyers gain patience. Sellers lose certainty. Investors tighten criteria or step back entirely. And cities that once felt safe begin to reveal structural weaknesses, aging infrastructure, fragile job bases, or housing costs that never truly matched local incomes. In this video, we're breaking down 7 U.S. cities where that reset is no longer theoretical. These are places where the slowdown is already reshaping behavior, balance sheets, and expectations. If you want to understand how these shifts affect real homeowners, real neighborhoods, and real money, make sure to like, subscribe, and turn on notifications. The stories ahead are already unfolding. 1. Lancaster. For years, Lancaster was marketed as the perfect middle ground. Charming brick streets, historic row homes, quiet neighborhoods surrounded by farmland. It was sold as a place where prices stayed reasonable, lifestyles felt stable, and nothing ever swung too far in either direction. That reputation attracted attention at exactly the wrong time. As larger metros became unaffordable, buyers arrived with outside money and outside expectations. Remote workers, long-distance commuters, and small investors all treated Lancaster as a substitute market. They bid aggressively, they waived inspections, they stretched for homes that once would have been priced comfortably within local reach. Local incomes never followed. That mismatch is now visible across the listings. Homes that would have disappeared in days now linger for weeks. Sellers list high, wait, then begin cutting in noticeable steps. Demand still exists in prime school zones and walkable pockets. But the moment a property sits just outside the most desirable areas or needs real work, buyer interest thins fast. Lancaster's housing stock makes this shift more painful. Many properties are old. Behind attractive facades are aging roofs, outdated electrical systems, inefficient windows, and plumbing that fails inspection more often than buyers expect. During the boom, those issues were easy to ignore. Today, they are deal breakers or leverage. Repair costs have surged. Contractors are expensive. Materials are not shown mercy by inflation. Buyers are factoring those realities into offers, and sellers who can't adjust are being left behind. The rental side offers no easy exit. Tenants are pushing back against higher rents, especially as nearby townships offer cheaper alternatives. A single vacancy can erase projected returns once taxes, insurance, and maintenance are fully accounted for. Lancaster hasn't lost its appeal, but it has lost its illusion of safety. What once felt like a dependable bet now looks like a market correcting toward reality. Slowly, quietly, and without urgency for anyone on the wrong side of the trade. So what happens next when a city's charm stays intact, but its affordability does not? 2. Scranton. Scranton has long been shorthand for decline. Closed factories, stagnant wages, a city frozen in a post-industrial identity. For years, that reputation kept prices low, and for a brief window, that low barrier to entry became its biggest selling point. When prices surged elsewhere, Scranton suddenly looked viable. First-time buyers realized homeownership might finally be possible. Small investors saw aging duplexes and oversized single-family homes as value plays. Renovations picked up. Sales data improved. On the surface, momentum appeared to be building. But the underlying math never changed. Most jobs in the region still pay enough to survive, not enough to comfortably absorb rising mortgage payments, higher insurance premiums, and the true cost of maintaining older homes. When interest rates rose and everyday expenses climbed, households that had stretched to buy found themselves with no margin for error. By 2026, the stress shows in subtle but telling ways. For sale signs stay up longer. Listings go pending, then quietly fall apart when inspections reveal more work than buyers expected or financing fails to clear. Price reductions have shifted from occasional to routine. Scranton's housing stock compounds the problem. Many homes are large, outdated, and expensive to modernize. Electrical upgrades, heating systems, insulation, and code compliance require serious capital. Investors who underestimated those costs are now sitting on stalled projects and empty units, both of which weigh down surrounding values. Cheap, it turns out, was never the same as safe. There are still blocks where disciplined buyers can make informed decisions. But the assumption that low prices alone protect against loss has been shattered. Values are sliding fastest in weaker areas, and sellers who bought late in the cycle are discovering just how thin the exit really is. If affordability was the promise, what happens when the bills finally arrive? 3. Bethlehem. Bethlehem was held up as proof that reinvention worked. A former steel town that transformed its industrial footprint into arts venues, offices, festivals, and a lively historic core. Add a strong university presence and proximity to New York and New Jersey, and the narrative wrote itself. For a while, the market believed it. Buyers from outside the region arrived looking for the next best thing. Row homes that once traded quietly became the subject of bidding wars. Modest single-family houses in preferred school zones jumped sharply in price. Investors moved quickly, especially in student housing and short-term rentals, assuming demand would stay constant. That assumption is now under pressure. By 2026, list prices in several neighborhoods no longer align with what local incomes can support. Sellers anchored to peak sales are watching their homes sit longer, often followed by steeper price cuts. Buyers have become far more selective, passing on properties near busy roads, tight lots, or homes requiring major renovations. Bethlehem's economy also introduces volatility. Demand tied to students, tourism, and festivals can soften quickly when households pull back discretionary spending. Parking congestion, traffic, and noise, once tolerated, are now reasons buyers hesitate or walk away entirely. Policy shifts add another layer. In response to resident pushback, regulations around short-term rentals have tightened. That changes the cash flow math for investors who bought at elevated prices, expecting flexibility that no longer exists. Longtime residents feel a different strain. Higher assessments driven by past price spikes collide with wages that never made the same jump. Taxes rise. Monthly costs creep upward. Selling now often means accepting less than expected. Bethlehem isn't collapsing, but it is cooling in a way that exposes how quickly a success story can stretch too far when outside demand outruns local reality. When a city's revival depends on visitors and outside buyers, what happens when both slow at the same time? 4. Harrisburg. As Pennsylvania's state capital, Harrisburg carried an assumption of built-in stability. Government jobs, legal offices, lobbying firms, a steady employment base that was supposed to insulate the housing market from sharp swings. For years, that belief held. Then cheap credit arrived. During the boom, development surged along the riverfront and into nearby neighborhoods. Renovated row homes, newly built townhouses, and expanding suburbs all benefited from demand driven by remote and hybrid workers. Prices rose quickly. Bidding wars became common. Harrisburg stopped being boring but safe and started feeling competitive. That shift is now reversing. By 2026, price reductions have become routine. Homes that once attracted immediate offers are sitting longer. Buyers are negotiating harder, and sellers are discovering that the state capital label no longer guarantees protection. Properties with river views or top school access still draw interest, but the broader market has clearly cooled. Environmental and infrastructure risks are part of the recalibration. Living near the river brings flood exposure, basement concerns, and long-term maintenance risks. Insurance providers track those threats closely, and premiums reflect it. Buyers now factor those costs directly into what they're willing to pay. Suburban expansion adds another pressure point. Homes farther out offer space, but they depend on affordable commutes. Rising fuel costs, tolls, and vehicle maintenance make long daily drives less appealing, especially for households already stretched by higher mortgage payments. Harrisburg is not collapsing. It is transitioning, and that distinction matters. The buyers most exposed are those who assumed stability was automatic. In a market where financing costs, insurance, and maintenance all rise together, even dependable cities must reprice themselves around reality. If stability was the promise, what happens when the numbers no longer support it? 5. Allentown. Allentown spent the past decade being sold as a comeback story. Downtown redevelopment, a new arena, modern apartment blocks. Constant messaging about a revived Lehigh Valley turned the city into a symbol of mid-sized urban renewal, done right. For a time, the numbers supported the narrative. Rents rose. Sale prices followed. Vacancy tightened. Investors and developers treated momentum as proof that demand would remain deep and durable. New units kept coming online, and buyers paid premiums simply to be part of the turnaround. That confidence is now being tested. By 2026, Allentown shows clear signs of strain. Not collapse, but pressure. Some newly built or freshly renovated properties are still performing. Others are offering concessions, reduced deposits, free rent periods, and incentives that were unthinkable during the boom. On the ownership side, buyer psychology has shifted. People are no longer paying top dollar for the story alone. They are scrutinizing schools, neighborhood safety, parking, traffic, and taxes. Homes on busy corridors or near high-traffic routes face heavier resistance and deeper price cuts than quieter residential pockets. The deeper issue is uneven recovery. Investment did not lift the entire city equally. Some blocks look transformed. Others show little change. That disparity matters when buyers walk neighborhoods, when appraisers select comparable sales, and when lenders assess risk. Layer in higher interest rates, rising utilities, and steeper insurance costs, and the margin for error narrows quickly. Investors who expected easy flips or stable cash flow are revising projections or exiting altogether. Allentown is not beyond recovery, but the phase where excitement alone supported pricing has ended. Right now, values are adjusting fastest where optimism ran ahead of fundamentals, and where belief replaced patience. When a revival story slows down, who is left holding the most risk? 6. Pittsburgh. Pittsburgh spent years carefully rebuilding its identity. Healthcare, higher education, and technology replaced steel as the city's growth narrative. Trendy neighborhoods, river views, and a steady inflow of outside capital reshaped the perception of what had long been considered an overlooked market. For a while, the optimism looked justified. Investors poured into areas near universities and major hospitals. Buyers targeted neighborhoods once labeled undervalued, assuming they were catching the next breakout early. Prices in places like Lawrenceville, the Strip District, and parts of the East End climbed well beyond their historical norms. That assumption is now being tested. By 2026, the pullback is most visible in the very areas that heated up first. Bidding wars have given way to slower negotiations. Sellers who price based on peak comps are being forced to adjust as listings linger and price cuts accumulate. Some deals fall apart late in the process when inspections might uncover more work than buyers expected. Pittsburgh's distinctive housing stock plays a major role in this shift. Steep lots, aging retaining walls, complex foundations, and outdated mechanical systems are expensive to maintain. These risks were tolerated when borrowing was cheap. At today's rates, buyers are far less willing to absorb them at premium prices. The rental market is also tightening. Student demand fluctuates with enrollment trends. Healthcare and tech workers are paying closer attention to commute times and neighborhood quality. Landlords who push rents too far are discovering there's a ceiling, and tenants are willing to move. Pittsburgh still has real strengths, but the belief that it was permanently undervalued is fading. What's happening now is not a rejection of the city. It's a recalibration toward what local fundamentals can actually support. When a market built on confidence loses momentum, how far does reality pull prices back? 7. Philadelphia. Philadelphia earns the final spot because it concentrates nearly every housing pressure facing Pennsylvania into one vast, uneven market. During the era of cheap money, Philly absorbed enormous demand. First-time buyers stretched to secure small row homes in desirable districts. Investors flooded entire corridors with renovations. Buyers from New York and New Jersey arrived with cash, confident they were still early compared to coastal markets. For a moment, it felt like everything was rising at once. That moment has passed. By 2026, momentum has slowed across large parts of the city. Homes that once sold immediately now sit. Price reductions are common. Properties with narrow layouts, aging systems, limited parking, or deferred maintenance are seeing the sharpest pullbacks. The older the home, and much of Philadelphia is old, the more unforgiving the market becomes. At the same time, ownership costs continue to rise. Property taxes reset higher after peak valuations. Insurance premiums climb. Utilities and labor costs add pressure. Roofs, brickwork, plumbing, and heating systems demand constant attention. Many buyers who assumed they would refinance later are discovering that cheaper financing simply isn't available anymore. Quality of life concerns amplify the strain. Crime perception, school performance, sanitation, and transit reliability now weigh heavily on buyer decisions. Families who once targeted specific city neighborhoods are increasingly choosing inner ring suburbs where costs feel more predictable, even when prices are similar. Investors are adjusting as well. Short-term rental rules have tightened. Tenants resist rent hikes. Eviction timelines and maintenance obligations complicate cash flow. Quietly, some small landlords are selling, not because they want to, but because holding feels riskier than accepting a loss. Philadelphia is not collapsing. It remains the state's economic and cultural engine. But its housing market has entered a phase where prices bend under pressure instead of climbing on belief. And in a market this large, even modest declines translate into widespread consequences. If the biggest market in the state can no longer rely on momentum, what does that say about everywhere else? Taken together, these 7 cities tell a consistent story. Home prices rose faster than local incomes. Outside money chased yield. Investors assumed flexibility that no longer exists. Aging housing stock was overlooked, while cheap credit disguised weak fundamentals. And for a time, belief replaced caution. That phase is ending. What's happening now is not always dramatic. It's quieter than a crash. Homes sit longer. Price cuts stack up. Deals fall apart late. Losses arrive slowly, 1 month at a time, for anyone who bought near the peak without room to maneuver. The most important shift is psychological. Buyers have patience again. Sellers are losing certainty. The assumption that housing always protects you is being replaced by a harder question. What does this property actually cost me to hold? In Lancaster's Kester, charm collided with affordability. In Scranton, cheap proved fragile. In Bethlehem and Allentown, revival ran ahead of reality. In Harrisburg, stability stopped being automatic. In Pittsburgh, confidence met maintenance costs. And in Philadelphia, scale magnified every mistake. This doesn't mean housing is finished, but it does mean the rules have changed. The cities that adjust quickly, where prices realign with wages and ownership costs stabilize, will recover first. Those that cling to peak-era expectations may spend years grinding sideways or downward. So the question that remains isn't whether prices can fall further. It's whether buyers, sellers, and investors are willing to accept a new definition of safety. If you're watching this unfold in your own city, share what you're seeing. And if you want to follow how these shifts continue to reshape local markets, like the video, subscribe to the channel, and turn on notifications. Because this reset isn't finished yet.